On April 20th, 2020, the oil price plummeted once again, with headlines all over the world stating that oil futures were now negative, meaning people were willing to pay you to take oil off their hands. With prices continuing to stay low, you might be asking yourself whether right now is the time to get in on oil. Some people are bullish on oil, while others say that it's a thing of the past and it's time to move into renewables. Navigating this politically charged landscape around a product that is so central to our everyday lives is tough for investors both big and small. Should you buy oil now and reap the rewards when the prices go back up? Why is the price of oil so low in the first place? And isn't the socially responsible thing to do to invest in renewables even if they don't make as much money? Should you invest in oil? This is often a question of ideology. Conservatives invest in oil companies, liberals invest in renewables. One is putting short-term profits first, while the other is putting the planet first and their wallet second. This political juxtaposition is neither true nor useful when trying to understand the ins and outs of the commodity market.
The reality is that when you talk about $45 billion of investment a year in renewable energy, is not because of ideology. These are because they make money.
You're about to see how oil and renewables can coexist and have peacefully been coexisting for years, collectively pushing our economy onwards. You see, the most successful investors aren't ideological. They might have their political affiliations, but like you and me, they're trying to make money. And according to thought leaders throughout the world, we may be at a critical inflection point when it comes to energy markets.
If you look at the wind energy coming online in Texas, it ain't about the politics.
By the end of this video, you'll see you don't have to be an activist to invest in renewables. In fact, many people that do so entirely motivated by profits. But to understand why that's the case, we have to understand the oil market and why increased oil production is paradoxically pushing renewable energy forwards in ways that we couldn't have predicted 5 years ago. If you're going to invest in energy, you have to be able to predict the future price of the commodity you're buying.
If you own oil, you should only own oil if you expect these prices to go up significantly.
When it comes to oil, that basically means you've got to understand how much is being produced and how much is being consumed. Lots of oil needed means that existing supply becomes expensive and the price goes up. This is important to investors like us that are looking to make money, but also for governments who aren't just looking to trade oil in order to grow their countries, but also have to think about political leverage and how the price of oil can be used against them. So at this point, you're probably wondering, so what? All I need to know is whether we're going to need more or less oil in the future. Well, yeah, but that's not the whole story. When looking at supply and demand, it's imperative to note which one is more influential when it comes to market dynamics. Overall, changes in demand are fairly stable and occur over long periods of time. If demand was the main driver of oil prices, then we wouldn't see such vast fluctuations. Now, of course, demand's important. If the whole world were to suddenly stop using oil, then there wouldn't be any demand for oil barrels or oil futures. Something along those lines happened on April 20th, 2020, when oil future contracts expired. However, due to the pandemic, demand was at record lows. The holders of the futures contracts had to physically take possession of the oil, and with storage running low, it became much more expensive. So yes, in the short term, oil price can be pulled down by a lack of demand. But in this case, in line with typical patterns, the price of oil went down shortly afterwards, and demand soon began to pick back up. However, the price of oil still didn't go above $50 a barrel. So it looks like demand can't be driving most of these long-term changes. But if it's not demand, then what is it? It must be supply. So in order to understand oil prices, we have to understand supply. Two things factor into oil supply: how profitable it is to extract oil, and how democratized the extraction of oil is in a given country and across the globe. The profitability of the extraction of oil depends on how much it costs to extract 1 barrel of oil out of the ground. Back in the day, you could probably go to Texas, pick up a shovel, start digging, and sooner or later you're going to get some oil that's spurting out of the ground. Today, oil's a little bit harder to find, so offshore drilling had to be invented along with other novel technologies that allowed oil to be extracted at scale, especially in the US. Whatever technology you're using, there's going to be a certain cost per barrel for extraction. If the cost is lower than the current price of oil, then you'll switch your machines on. If the cost is higher, then you'll just leave them switched off. Democratization of oil production is essentially how much central control a specific body has over the production of oil. Oil used to be exported primarily by a small number of countries controlled by one single cartel, OPEC. Because of novel technologies like fracking, the US is now one of the leading countries when it comes to oil production. In fact, they're one of the top 5 exporters of oil and gas globally. So while in the 1990s, burning oil fields in Kuwait was a source of worry for the importing United States, now because they export so much, they can actually benefit from the price being high.
We have over 4,000 producers, so no central figure can control production.
Because of the many global players that have now entered the oil industry, the oil price is a lot more controlled by market forces than it used to be. Even if OPEC decides to cut supply, increases in global competition from places like Russia and the US can still keep supply relatively high. And because of price wars between those countries who are all trying to attain global dominance when it comes to energy, the price of oil remains relatively low.
But it seems that Saudi Arabia and Russia, they are vying for this oil supremacy.
So what does this mean for us, the investors? How can you make money off this? When oil prices decline, yes, it means that oil is cheaper to use, so demand will go up a bit, but oil is also making less money, so less investment is going to go into the commodity. This is important when we think about prices, because we rarely really think about investors and how important they are when it comes to affecting the price. In the old world, low prices meant lower production because producers wouldn't make as much money from extracting the oil. This would bring down supply, which would bring up the price, and more investment would come flooding back in. This time around, things might be different. Because of the democratization of oil and the easier extraction methods, the global supply of oil isn't going down as much as you might think. Meanwhile, energy investors aren't getting the returns that they need, so what happens? They turn to renewables, an area that's rapidly growing. Investors around the world are beginning to clock onto the fact that renewables can be an extremely lucrative sector to invest in, so many are starting to make the switch. That's why, in all places, Texas is the leading state when it comes to renewable investment.
And when oil prices declined, the result in UAE, the action that was taken, was removing the fossil fuel subsidies.
Here's the key. When the price of oil goes down, the global oil production will also go down, as it's not as lucrative to extract oil as it was before. However, the global supply won't go down as quickly because there is so much oil being held in storage. Assuming demand stays relatively stable, oil production might stop entirely, but there's still excess oil in supply that's being sold off the shelves at lower prices. You can't just wait indefinitely until happier days come around and the oil price goes back up. At the same time, other countries that have lowered their extraction costs are still happily producing oil because their cost of extraction is below the actual price. What does this mean for countries like the US? Well, it means that investors will inevitably move from oil into renewables. That's where they see the money. And it's looking like gas is acting as a transition commodity.
Gas is going to be the fuel of the future alongside renewables in order to be able to look at it not only as a business investment commodity, but as a mechanism to clean the air for people to be able to breathe.
And the price of oil is probably going to go up again, and then it's probably going to drop again. But with the energy landscape this complicated, it's difficult to predict whether you're going to be able to consistently make money from investing in oil. On the other hand, tech development in renewables, increased storage capacity through batteries, and most importantly an influx of investor money, make renewables a solid bet for both the short term and the long term. Experts used to think that renewables would only really take off once oil got to $200 a barrel, because oil would become too expensive to use and every industry would switch over to renewables. However, the developments in the oil markets have resulted in a higher demand for investing in renewables because of their stability of price regardless of where the oil price happens to be sitting, and their predictable future growth. Wind and solar aren't so much tied to market prices as they are to technology, which is a lot more predictable than markets are. Also, it means that countries won't be so reliant on global market dynamics as they used to be, giving them more political independence. For some countries, this will mean having the ability to export wind, water, and solar power on top of their oil exports, but for most, it'll mean just being a little bit more energy independent. For example, Caribbean islands will be able to harness near year-round sunshine to power and grow their economies, and even export some of that energy with new tech. What does that mean for you? As usual, it means to diversify and realize that oil and renewables don't have to be subject to some ideological debate. If you've always been bullish on oil, then look at those oil investors that are putting part of their funds into renewables and examine their logic on both the local and global level. And if you're an investor in renewable energies or you're a climate activist, instead of getting frustrated when the supply of oil increases, remember the fact that the increase in supply of oil is probably driving the price down, meaning that more investment is being funneled into renewables, which you have a stake in.